My mission is simple: to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make a little money. My job is not just to entertain, but try to explain what the heck's going on. So call me 1-800-743-CNBC. Tweet me at Jim Cramer. You know why you need to stay diversified? Because of darn days like today, where the Dow advanced 244 points, closing above 41,000 for the first time ever. But the S&P plunged 1.39%, and the Nasdaq plummeted 2.77%. If you only own the big tech stocks that we talk about so much, the ones that have been leading this market until a week ago, let me tell you something. This day might make you want to give up on the entire asset class. And I bet some, if not many, will do exactly that. Yes, it was that ugly. I got to try to prevent that. Before we get into it, I want to say something about the stock market and what it means to me. It's been 40-odd years since I came down here a block away, and I've always been amazed at how compelling the market can be. I regard it as a gigantic puzzle. I'm always trying to piece things together, figure out if a stock might be a buy or sell. But I know something else. Most people just don't care about individual stocks, would rather just be in some mutual fund rather than be burdened by the difficulty of managing their own portfolio. They want nothing to do with the puzzles. Today, for example, I spent an hour with CNBC Investing Club members and Jeff Marks, where all we did was talk about which stocks win or lose if Trump's the next president. It's a critical issue. Some would say it's driving this entire sector rotation. Of course, the rotation started last Thursday when we finally got a low consumer price index number. When we saw the CPI, most investors figured it was time to buy stocks that really benefit from lower rates. Going to get some rate cuts, mostly home builders and what goes into a home or Home Depot. However, I have to tell you, very few people were prepared for a gigantic, kind of inexplicable rotation out of winners into losers all at once, as if the mega cap tech stocks really hit a wall and they really do poorly in a lower interest rate environment, and they've had their days in the sun and are fini. In reality, they do well regardless of rates, which is precisely why people sold them and frantically shifted into the kind of stocks that can put up explosive earnings growth, but only when rates go lower. On Friday, we had a fairly broad-based rally led by small caps. Again, it wasn't clear why the big cap stocks were out of favor. The small caps just kept running. Then we got the events of the weekend, which led to a new consensus that Trump's extremely likely to win the election. Suddenly, the mega cap tech winners became huge share donors to the loser stocks that had done nothing for ages. Now, here's where it really gets interesting. The shift from winners to losers mirrored the politics of Trump. He and his running mates see themselves as populists, something that's been out of favor for most of my lifetime. They see many big capitalization companies as enterprises that have sold out America in the name of higher stock prices. They abandoned small towns, USA, closed the factories, laid off the workers, and made their merchandise more cheaply overseas. Some of this rhetoric is, I'm telling you, it's right out of the late 19th century, as though they're channeling William Jennings Bryan, railing against the bankers, crucifying mankind on a cross of gold. How does this translate into stock performance? Well, the big institutional investors want to get right with Trump, right? Because they think he's going to win. That means buying the stocks of small to medium-sized businesses that weren't involved in the abandonment of rural America, something you can read about in J.D. Vance's memoir, Hillbilly Elegy, which is not a particularly conservative book, by the way. You know what? If you read it a different way, you would think it's actually a left-wing manifesto of sorts. It also means investors are getting ready for more protectionism. Last night, we learned that Taiwan is being vilified by Trump for stealing a crown jewel of American industry, the semiconductor manufacturing business. It's to the point where he indicated that he might lift a finger if China tries to invade. Holy cow. The narrative fits perfectly with today's action. People are talking about it broadening out, but I think that most did not believe that it's a game over for the big dogs, even if you thought they're part of the problem, not the solution. But that's sure what the sellers. I've got the sellers of the techs in the last half hour. They were like, please, tomorrow something really bad's going to happen. I got to get out now. Get out now. But now let me get back to where I was started, okay? As much as I love to tell you that all of today's action made sense, including the continual boosting of bank stocks, because people recognize the industry is going to benefit from deregulation in the event of a Trump win, I just can't believe it. In fact, I know it's not true. Days like today don't encourage people to invest in individual stocks, even as we all know that there's been far more wealth created by owning an Apple or an Nvidia or Microsoft or Amazon than an S&P 500 index fund. By the way, all those stocks were down badly. Why don't people own these fabulous individual stocks over time that have made so many millionaires out of relative paupers? The reason actually is simple. Most people are not diversified. I learned 40 years ago that not all stocks can go up at once. That's why staying concentrated in a handful of stocks is a recipe for disaster and for giving up, especially if they're all part of the same sector. This weekend, while doing some charity work, I heard from a bunch of people who wanted to know why, they were club members, why I stick with such losers like Best Buy or Abbott Labs, instead of just going all in on Nvidia and Amazon or Apple and Alphabet. I was actually upbraided for buying the stock of Ford for the charitable trust. What a loser. But Ford, Best Buy, and Abbott are the secrets to staying in the game. On days like today, where our position in Nvidia just torpedoes the charitable trust, I concentrate on the gains we got in Honeywell or Linde so I don't go crazy. If I didn't have them, if I had nothing but, say, Nvidia and Meta, I'd say, get me out of this stupid casino. I'm done with stocks. I can't take the pain. The house of pain. However, because my trust owns a smattering of industrials, retailers, and healthcare, I actually can handle the pain. And it's pain that drives people out of stocks, even as they know they'll probably never get rich if they just park their money in an S&P index fund of the 500, an amalgam of good, bad, and indifferent stocks, where you are resigning yourself to a great deal of mediocrity. I believe in diversification enough that I never mind you owning an index fund, but I want it to be side by side with individual stocks that could potentially make you fortunes. That's why I started the CNBC Investing Club. I know, though, that you won't stick with those stocks if you're undiversified. The pain is just too great on days like today, and then tomorrow you're finished with it. So while you could argue the small, medium-sized businesses have been strong because of lower inflation or the Republican ticket, you could also say some large money managers decided that big tech hadn't gone too far. It was time to sell that and switch to the perennially underperforming Russell 2000. That rush of money into these small-cap stocks sent them to the moon in 5 days' time, and that's what you witness. You know what? I honestly don't care which explanation you prefer. What matters is that you're now getting a chance to ring the register on the winners from this rotation, just a fantastic game, and start making your list of what to buy that's being thrown out. That's what we've been doing. Why do that? Because people like to chase and they hate to buy down. They like momentum and they hate free fall. They're inclined to panic and they toss out great stocks because of fear. They only own stocks like Nvidia because they were hot. And suddenly, well, you know what? They're not hot anymore. But for you, that could soon be a buying opportunity. Hey, perhaps as early as tomorrow, as we just had our third day of this rotation, and that's when they kind of run out of steam. Too late to buy those stocks for sure. Listen to the bottom line I've got here. For all my years down here, I know that if you self-immolate on days like today because you ignore diversification, put everything in some of the Magnificent Seven, you are doing something wrong. And what can I say? I don't know, because you almost certainly aren't watching this show. Milord in Michigan. Milord.
How you doing, Cramer?
Cramer doing okay. How about you, partner?
I'm good. I just want to say, thank you. We appreciate everything you do for us.
Thank you. These are hard. These are trying days, aren't they?
Thank you. Oh, yeah. It's just like, we got a roughly day to day.
Yeah, we did. But yeah, look, if we only just own United Health and Johnson & Johnson, we'd be geniuses.
Of course. Cramer, I just have a question about McDonald's. McDonald's year to date is 13% down. And as we know, we have their earnings coming soon in 2 weeks. What should we expect from this company, consumer discretionary? And we know,
Okay, I will tell you that when you buy McDonald's when it's down, it has tended to be a great call. Now, and what happens is that like United Health, like PepsiCo, like Coca-Cola, these great brands, people can't get enough of them. So what'll happen is it may not even be that good a quarter, and I still don't think it'll go down. That's how low it's come. It's down 12%. That's kind of where, down 12 to 15% for McDonald's. That's a pretty good price to get. All right, now days like today, where we saw a real bifurcation in the market, prove one of my most important and oft-repeated pieces of market wisdom. You got to stay diversified. Oh, man, money tell you. Close watchers know that we have been looking for brown shoots in this market. One of the earliest signs of them were the transports. So I'm giving you an update on what the sector is telling us about the health of the greater economy. Then I have spotted this lesser-known AI play I got to put it on your radar screen. You won't want to miss that. And First Horizon reported a quarter this morning that disappointed the street. It's been such a winner. Let's go speak to the CEO. Stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Over the last few months, I've been using a new term, a Mad Money original, brown shoots. You hear about people talk about green shoots all the time. That's when they see signs of a stronger economy. Brown shoots are the opposite. They're the first signs of a weakness, a weaker economy after a period of strength. It's these brown shoots that have given the Federal Reserve the confidence to start thinking about cutting rates as early as September. I started talking about brown shoots on April 18th. That was after we got some really ugly numbers from a pair of logistics plays. J.B. Hunt, big trucking company, Prologis, the REIT that owns warehouse and fulfillment centers. That 1-2 punch was the first sign of a broader weakness in the economy. I picked it up, and believe me, everyone's kind of caught on since. I bring this up because both these companies have now both reported their second quarter numbers. J.B. Hunt last night, Prologis this morning. I want to update you on what we've learned from the latest numbers. These are two companies that are integral to the U.S. economy. Let's start with J.B. Hunt, which reported a very weak set of results. Weaker than expected revenue, down 7%. A 5% decline in revenue per load for the intermodal business, with load volumes down 25% at their integrated capacity solutions division, while their truckload and dedicated contract services units both saw 9% declines. Brutal!
A house of pain.
Meanwhile, J.B. Hunt's operating income fell by 24% year over year, also worse than expected. Management attributed the hit to, and I quote, higher insurance and claims, equipment-related and certain personnel-related expenses, end quote. J.B. Hunt's net interest expense was also up 38% year over year, thanks to higher rates and debt balances, so they ended up delivering a 16-cent earnings miss off a $1.48 basis. Now, this trucking company doesn't give formal guidance, so the management's commentary on the conference call is even more important than usual. And as bad as the numbers were for J.B. Hunt, the call was somehow worse, with an adversarial analyst community grilling management about when will things get better. They really went after the company's new CEO, Shelley Simpson, who just took over beginning of July. Just July. I mean, I thought it was a very painful call. But here's what you need to know. The most important takeaway. Simpson refused to call a bottom. She said that, and I quote, we're at least closer to calling some kind of inflection, end quote, but she refused to go all the way. That's not good. Between the distinctly suboptimal numbers and Simpson's refusal to call bottom, investors fled from the stock, sending it down 7% today. Wow. That said, even after this big pullback, J.B. Hunt's only giving back about 3 days worth of gains. After getting wrecked after the last report in April, the stock traded sideways until the middle of last week, when it finally took off alongside the small caps and the whole transport index. So obviously the transport index was wrong. It was a group move. Everything goes up, and then we pick off the individuals that didn't do that well. Now, the stock's given back a little over half of its gains from the past week after the company said, in effect, not so fast, to the investors who were starting to bet on a turn. So what do these numbers mean for the rest of the transports? Because the transports are acting so bullishly. CNBC's terrific global supply chain reporter, Lori-Ann LaRocco, had a fantastic piece on CNBC.com today, where she noted that many logistics executives are ready to call an end to the long-standing freight recession. For example, Hamish Woodrow, he's the head of strategic analytics at Motive, which tracks trucking visits to major distribution facilities for retailers. He said to CNBC, quote, when I look at the trends, what is pretty clear here is compared to last year, where retailers were destocking, so they were artificially not bringing in inventory, we now see strong restocking trends, end quote. I also got the impression that Shelley Simpson mainly refused to call bottom on J.B. Hunt's call, not because the data's ugly, but because you don't want to make that kind of risky cold shot on your first ever conference call as CEO. Too much of a gamble. Now, she did have that opportunity to do so when her team said the business had improved on the West Coast, again, related to imports for retailers. But she chose not to. However, you know what? Look, I don't blame her. You don't want to say something positive on the call and then you may regret it later. That's a real black mark. So let's bear with her. Hey, how about this Prologis, the giant smart warehouse company? First, this stock has been a much better performer than J.B. Hunt. Even though it collapsed in April, it actually started rebounding again in May, and it's been rising ever since. That disparity in performance makes a lot of sense because this morning Prologis turned in a very solid quarter, in-line revenue, slightly better than expected funds from operations. They have a key profitability metric for real estate investment trusts. All of those were very, very positive. And I've got to tell you, I don't know if you caught the CEO this afternoon, but I think he was much more confident about how things look. And maybe it's because of this. Their occupancy rate came in at a solid 96.1. Their cash same-store net operating income grew by 7.2%. Those are very good numbers. Now, on Prologis disappointed in April, the issue wasn't actually the quarter itself, which was good, but the fact that Prologis slashed its full-year forecast. Blaming the weak outlook on a more competitive operating environment. This time around, though, Prologis didn't cut its guidance. They only tightened their funds from operations outlook while keeping the midpoint the same. Other than that, they mostly reiterated the numbers. Not bad. In the earnings release, Prologis Chairman and CEO Hamid Moghadam said, quote, "We continue to outperform the industry driven by our team and the quality of our assets. While customer demand remains subdued, it is improving, and we expect the trend to continue as the construction pipeline shrinks." End quote. That is very positive. In short, it was a solid update from Prologis with no real setbacks, and that alone makes this a better quarter for the company than the one they gave us in April. Stock managed to gain about 1% today, maintaining momentum that it's had over the past few weeks. So let's get back to the original question. How do these latest updates from J.B. Hunt and Prologis make us feel about what we call the macro environment? The answer overall, after hearing from J.B. Hunt and Prologis, I feel better about the economy, but only slightly better. Still need that rate cut. If you take J.B. Hunt's quarter by itself without considering the broader context, you probably feel worse about the transports in the entire economy. But after hearing management let slip some comments about improvements towards the end of the quarter, and considering the fact that Shelley Simpson just took over at the beginning of the month, plus the more positive outlooks from others in the industry, I am willing to go out further on a limb than Simpson. I'd say the trucking business is at least bottoming right now, perhaps even bottomed already. As for Prologis, they had a legitimately fine quarter, which is an improvement from 3 months ago. And when you layer in management's cautious comments about improving customer demand, I certainly feel better about this warehouse situation than the last time they reported. But the bottom line, look, these are just the kind of clues. These are a couple of clues that we'll get on transportation and logistics, with many more to come as the earnings season unfolds over the next few weeks. And believe me, I'll be watching like a hawk. We want the pain to stop, even as we can't have too much improvement without jeopardizing the possibility of getting those Fed rate cuts that we need from the Fed. Particularly, we got to have one in September. Everybody's back after the break.
Coming up, light bulb moment. Cramer shares an illuminating take on an AI play. Next.
For the past week, the most beloved stocks in this market, the artificial intelligence plays, they've been selling off like crazy. And today, the whole group got totally obliterated when former President Trump put the squeeze on Taiwan, saying they should pay more for their own defense. Given that they manufacture almost all the most essential chips that we need, that could be brutal for the industry. So everything from NVIDIA to AMD and Micron just clobbered. Negative pin action spreading into the everything AI-related areas. Supermicro, we heard from them earlier this week. Dell, HP Enterprises for servers. Arista Networks, what a great company for network equipment. Broadcom for hardware infrastructure. In other words, all the winners for the last year, and the trust has got a bunch of them. We did talk about them in today's meeting, if you want to go and look what I had to say. There's another AI hardware play that got hit hard today, or at least an industrial company with an AI kicker, even though it hasn't run anywhere close to as much as the pure plays have. I don't want to give up on what I consider the next industrial revolution, but I know it can take time before these sector rotations run their course, and they can be quite frightening, which is why I like some of these AI-adjacent names into weakness. They've got less downside. Specifically, I'm talking about Hubbell. Hubbell. That's a 135-year-old company that makes utility and electrical solutions. That includes so-called front-of-the-meter solutions used by utilities and telco carriers to help transmit and distribute energy to customers. Edge solutions, like the actual meters that allow data and energy to be distributed back and forth between utilities and their customers. And behind-the-meter solutions, used by owners and operators of non-residential buildings, manufacturing facilities, and critical infrastructure. So they really got the soup to nuts going here. Over the past 7 years, Hubbell moved towards higher tech products like smart meters and away from more commoditized equipment, especially in the lighting space. I know this is arcane, but bear with me. This is cool stuff. Hubbell's gone from a company that primarily served the construction and industrial markets to a company that mostly sells into the utility market with a much smaller non-residential construction business. Then why does it matter that they're in utilities? Well, given that the demand for electricity is off the charts in this country, thanks to the AI-fueled data center build-out, Hubbell's end markets now much faster growth than the old end markets. And best of all, they carry much higher margins, so they make much more on everything they sell. And that's because this company now has major exposure to some of the strongest secular themes of the market. Even if the stock market's put many of them to the meat grinder over the past week, and they're flushing out all the weaker hands. Again, that's what's going on. We don't know when it's going to end. We're trying to find good companies to buy into the weakness. First, there's reshoring. Companies bringing back manufacturing in the United States after global supply chains got so snarled during the pandemic. These new domestic manufacturing initiatives have led to mega projects all over America. And these projects need to connect to the power grid. Hubbell's there to help them do it. After these mega projects come online, they'll result in energy load growth, which benefits Hubbell's utility customers too. The second major theme, grid modernization. Now, we've seen major failures in the nation's electric grid in recent years. It hasn't been updated in years. No one put money into it because no one thought it was going to grow. And given that electricity demand is now growing at a 5% annual clip, it hasn't grown for years. Things will only get more difficult if we don't modernize our grid. That's why I keep telling you that's a great business. Thankfully, there's lots of federal support for these efforts. The $30 billion combined from Biden's infrastructure bill and the so-called Inflation Reduction Act. Ultimately, if it brings down power, maybe I'll stop being so sarcastic about the name. But this is great news for Hubbell, because many of their products help automate energy transmission and distribution operations. That's exactly what we need to modernize the grid. Third, there's sustainability and alternative energy. When new wind or solar farms get built and plugged into the grid, that means more sales of Hubbell's products. But Hubbell also makes products that help building owners use energy more efficiently, lowering their costs and helping them hit their sustainability goals. Many big companies have those goals. Some little ones too now. Last but not least, how does Hubbell benefit from the AI-fueled data center boom? Simple. We're going to need a lot more energy to support these facilities. And when utilities expand their production or transmission capacity, they need equipment like Hubbell's. More important, Hubbell first came on my radar as an AI play in March when the company was part of a presentation during NVIDIA's GTC event. Remember I went out there in San Jose? It was about the increasing complexity of the electric grid in the AI era. I didn't know anything about this. The main message, we now need AI to help manage the grid because power grids will have to do things like adapt in real time to severe weather, facilitate two-way power flow with more home solar assets and electric vehicles, and manage costs as energy gets more expensive and resource shortages and expensive infrastructure upgrades have to occur. In fact, there's an NVIDIA-backed startup called Utilidata looking to introduce AI decision-making to the grid. And earlier this year, they announced a partnership with a Hubbell subsidiary that specializes in smart meter technology. They're the first company to embed Utilidata's platform in their smart meter systems. And I know you always tell me, please tell me what Jensen Huang's up to, and this is one of them. This partnership is still in its infancy. You can't expect much in the way of revenue from it anytime soon. But Jensen Huang, the visionary CEO of NVIDIA, as just mentioned, seems very focused on this project and more generally on using AI to modernize the grid. Remember, he also wants to have the grid generate less heat, obviously reduce the carbon footprint. Now, last month, Hubbell hosted an investor day where it gave us some additional color on the data center opportunity. Again, it's not a huge business. We accounted for just 3.3% of Hubbell's sales last year. But management expects this to be one of the fastest growing businesses with double-digit organic growth through 2027. Hubbell's also acquired a company called PCX 2 years ago, which makes modular power solutions, again, for the data center. PCX has great relationships with the hyperscalers who will be doing the most data center building. They're involved in the early construction phase of data centers. Remember, data centers are all down right now, so this is why we're presenting this piece now. So PCX represents a foot in the door for Hubbell, which management believes will help them cross-sell the rest of their electric hardware. Why do I bring up Hubbell on a day like today when the stock's down 6%? I mean, shouldn't I be focused on, I don't know, Solventum or something? Well, because you're not chasing the stock. Look, hey, how about I come to you here, right? I say, listen, you got to buy this at 387. It's going to 400. Well, you know what? That's called being a chump. This is when you come in knowing that it could go here, maybe here, but it's not going to go here, okay? Anyway, while this is a new suit, so I didn't want to go all the way to the floor. Well, it's been an excellent performer, up 92% over the past 3 years. The stock's already pulled back from 429 at its April highs to 366. Doesn't mean it's going to bottom here, okay? It just hasn't had the insane short-term moves like the pure plays on AI. So it doesn't deserve to be selling off hard. If you want to buy 100 shares, you buy 25 tomorrow, and then you leave some room and buy some more. Plus, Hubble's last quarter was strong. It's just that management left their full-year forecast unchanged when Wall Street wanted them to raise numbers. They report again in 2 weeks on the 30th, and while I don't have any reason to be negative, you should know I am not recommending this as a one quarter play. It's a long-term story. But here's the bottom line. More than a year and a half into the AI boom, we're now at the point where many of the most obvious AI winners are well-known, richly valued stocks that can easily fall prey to vicious declines during this kind of sector rotation. And that's why I'm researching the relatively under-the-radar AI plays like Hubble, a lesser-known supplier to the utility energy industry that has a good business now, but will do even better as the AI theme continues to take off and the mega caps build new data centers everywhere, regardless of who is president. Let's go to Peter in California, please. Peter.
Hi, Jim. I'm talking about
Peter.
Alphabet, GOOGL. I know it's got an AI play. I've had the stock for at least 6 years. I'm making a 250% profit. Is this still a hold, or should I take some profits from the stock?
First, it's an inexpensive stock. We did take some profits for the Charitable Trust in this company. Why? Because it ran up so much. And I'm not going to tell you that you shouldn't if we took some profits. That said, it's not that expensive, and it's a really good business. And you know what? This too shall pass. I mean, this stock could be, it's 181. It could go to 160. And all that would happen is you should be a buyer, not a seller. So I'm okay with it. Tom in New York. Tom.
Jim, good evening.
Good evening. What's up?
Thank you for taking my call.
Of course.
And let me start out with a great monthly meeting today.
Oh, thank you. Thank you very much.
Kudos to you, Jeff, and everybody involved.
Yeah, Jeff did a great job. And, we're sensitive to the idea. I wasn't positive about most stocks. I think they're going to come down. But we got capital. We want to do some buying. And, that's what you do into these panic sell-offs. How can I help?
Jim, I called you a while back, right after the IPO on a cybersecurity startup. And I was wondering what your thoughts were nowadays after their solid first quarter numbers. Rubric, RBRK?
Yep, and I said I liked it, and I continue to like it. It's one of the companies that have come public in this period that I think makes a lot of sense. It's data security and cloud management. Now, there are a lot of companies that do that. I just said I wanted Rubric on air because I think it's a very exciting company, and it's been a big winner, and it was still up today. So anyway, thank you. Thank you for the kind comments about the meeting. This was the hardest meeting that we've done in, I don't know, I can't tell how many years, because we're trying to buy stocks that are going down, and we know they're going down. It's very tough to tell people to do that, but we don't know where they're going to bottom. Most AI winners are known. I want to look for the under-the-radar names, and I've come up with Hubble. I think it'll really start to shine as the AI-fueled data center build-out continues to take off. But we know, again, these groups are in down mode. You buy a little at a time. First, Horizon reported this morning, cutting its net interest income outlook and setting the shares lower. Bummer. I'm seeing if today's decline could be a buying opportunity if the stock's strong showing so far this year. Then Cramer fave Chipotle has been dogged recently by complaints of high prices and smaller portion sizes. So what do you do with this stock like this that's become a bit of a piñata? I'll give you my take. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Now that we've heard from the big banks, we're starting to get results from the smaller regional banks. Today, we had First Horizon, the Tennessee-based regional bank that missed numbers and cut its full-year net interest income forecast. That was because of increased competition for deposits in what is the hottest region in the country. And that's why the stock dropped nearly 6% today. First Horizon usually tends to be a steady operator, which is why its stock is still up 16% for the year. Think about that, even after today's pullback. So how concerned should we be about this new competition? Let's check in with Brian Jordan. He's the chairman and CEO of First Horizon to get a better read on the quarter. Mr. Jordan, welcome back to Mad Money.
Thank you. Thank you for having me.
Okay, so Brian, when I moved to New York in 1980, I opened an account at a bank, and they gave me a toaster because they wanted my money so badly. Are they giving toasters down there? Is that what's happening?
No, not toasters yet, but it's pretty darn close. We're seeing a tremendous amount of competition. It tends to be very aggressive for money market and CD deposit rates. We see a lot of specials in the marketplace. And what we experienced this quarter was a little bit of a shift in what we'd seen in previous quarters. We had about $1.5 billion that was at what we would consider back book or base rates that essentially repriced in defense of offers. So we were very cautious about not protecting our customer base. We wanted to ensure that we protected our customer relationships, our client relationships. And so we matched offers, and that raised the price of deposits overall. So if you looked at the first part of the quarter, that we saw our interest rates on deposits actually dropped April and May, and it started to accelerate with this competition in the June timeframe.
But how do you combat that? I mean, look, you're a solid bank. You're a good operator. You guys got coming in there, I guess, because you were in the hottest area of the country. I guess banks that don't have a lot of growth are coming in trying to pick up business.
They're tremendous growth markets, and in the aggregate data, you see that the deposit base continued to shrink on a national basis. It's a function of the Fed continuing to shrink its balance sheet, and our customer base is very strong. It's in great markets. There's a lot of competition coming into those marketplaces, and it drove a little bit of increase in cost. We are going to defend our customer base, and we think about it in the long term, not from a quarter-to-quarter basis.
Oh, but let's talk about the loan business. I mean, if you're in a great area, obviously there's still a lot of there's loaning to be doing. I read through this part. People seem to be worried about your commercial real estate. I mean, the 60% loan to value, they're not tall buildings where I'm worried about. I mean, basically, it seems like all the worries that people have are not being justified.
Yeah, I think. Look, commercial real estate is one of those things that is going through a bit of a down cycle, but it's not something that keeps me awake at night. As you said, our commercial real estate portfolio is very diverse. Half of our office portfolio is medical office, which tends to be 100% fully absorbed. When we look at our office portfolio, as you said, we tend to loan to 9-story buildings or less. I think we have 8 loans on buildings that are greater than 10 stories. It's geographically diverse across the footprint. Great borrowers, great borrower relationship, and very strong loan to values. So commercial real estate is under a bit of pressure. It gets a lot of coverage, but it's not something that keeps me awake at night.
Okay.
Not today.
Okay, so tell me about what happens. What's the denouement here? Do some of the banks realize, you know what, we're not going to pick up business? Or do we just stay in a dogfight for a long time and you can't give us the return that we want?
I think it's going to be an interesting environment, at least for the remainder of this year. And I think you've got the convergence of two major things. One is reasonably obvious with the presidential election coming up and what that means in terms of regulation, taxation, competition in the economy. There's likely to be a different outcome depending on who wins the White House and Congress. And then the second is the Fed going to cut rates later this year? When and by how much? And I think when those two questions get resolved, the economy ought to start to accelerate. Loan demand ought to pick up a little bit. And I think it is going to be a bit of a dogfight, as you suggest, for the remainder of this year. But I do think we see optimistic reasons to feel good about 25 and beyond.
All right. Now, we have a lot of people who watch the show who have mobility that move into Tennessee, Florida, and Texas. OK, if you wanted to be savvy, is it time to maybe ring the register in Nashville and go over to Memphis?
Well, it's an interesting question. I think we've had great momentum in Nashville, for example, in Tennessee for the last couple of decades, and it continues to grow very aggressively. We have a lot of things that are going on that are very attractive in Nashville. In Memphis, we're seeing XAI come here and build a facility here. We're seeing a lot of positive reasons for Memphis to accelerate. And I think that's true of a lot of the base cities we have around our footprint, whether it's a Birmingham, a Huntsville. We think we have a great footprint with a lot of opportunity for in-migration and strong economic growth.
Now, do you want to expand beyond that footprint, or is there still, because I don't want you to be in a dogfight for the next 2-3 years. Are there places that you can, that these out-of-towners don't understand, that you could go make a big hit in?
Well, I think we have the opportunity to continue to invest in this 12-state footprint that we have. We are undersized in a number of these markets, and we can continue to be very aggressive and competitive in those and continue to invest in places, like I mentioned, Memphis being one, but you've got Houston, Dallas, and Texas. You've got the entire state of Florida, essentially. You've got Atlanta, Georgia. You've got the Carolinas, the I-85 corridor from Charlotte up towards Raleigh, Durham, Chapel Hill with the Triad in the middle. We see a tremendous amount of opportunity to invest in this footprint, and I don't think we need to expand it.
Good. I don't want you to. You're in the best area of the country. You don't need to go down market. Well, I want to thank you, Brian. You're always a straight shooter. Brian Jordan, Chairman, President, CEO of First Horizon. Love having you on the show. Thank you.
Thank you.
Okay. Mad Money back after the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next.
It is time. It's time for the light round quiz. We're of course the same as occupied by myself. I don't know the course exactly. I tell myself we're playing this out. And then the lightning round is over. Are you ready, Ski Dad? It's time for the lightning round quiz. Might start with Chris in Alabama. Chris.
Good evening, Cramerica. Booyah, Jim. I'm a club
Booyah,
member.
right back at you, Crimson Tide. What's going on?
Hey, I'm on a 17% toboggan ride down from 202 to 166 with Aero Environment Inc., symbol AVAV.
I've got to tell you, one of the reasons why is that there are people in the Pentagon who think that maybe they're charging too much money. Now, they are few and far between. I think that this is the best bang for your buck, so to speak. But I can tell you that that's the weakness, and that's why the stock at 50 PE is considered to be too expensive. I like it, though. How about we go to Chris in Florida? Chris.
Hey, Jim. I got to start with a quick go Birds.
Hey, go Eagles. Absolutely.
Yes.
I like everything I'm hearing from training camp. I mean, like the subtle training camp, that real one hasn't started yet. What's up?
I love it. So I'm all about the logistics and transportation industry, Jim. Go Zell. Okay. There's two quick things that I wanted to ask you about. Just yesterday, Lineage talked about an IPO with a $19 billion valuation. I think it's going to be massive. But more importantly, a stock that you and I talked about a few weeks ago, you weren't entirely sold on it. I think it's still got room to run. Look at the last few days. FWRD.
Well, I'll tell you, you're right. I mean, look, the rest of the group has been carried up. The stock is down 60%. Losers will be winners. This is the slow ones now, will later be fast. I mean, it's like the times are changing. You might get forward, go to 28. Let's go to Bill in Massachusetts. Bill.
Booyah, Jimmy Jams.
Chillman says hi. What's happening?
I feel like opportunity is knocking, Jim.
Where that?
I trimmed off some of my tech stocks 2 or 3 days ago. I got lucky. But what I did was I sold NVIDIA last year at $450, $650, and $950 and put that all into Broadcom, Vertiv Holdings, DuPont, and Meta. Done
well
incredible.
Played. Well played.
Thank you. You were the only one, when I trimmed it at $450, the only one to say that there was nothing wrong with taking profit.
No, nothing. We took some at the beginning of the year. We thought it was the right thing to do. Okay, what's happening?
I'm ecstatic. I'm interested in General Dynamics. You told me last year it was great. You gave me the green light, and I'm doing great on it. I'm happy. I want to buy more.
Okay. I can bless that because it's not an expensive stock and it's a great company that I've been dying to have on the show, but I've had very little luck. But maybe my luck's about to change. But I think you'll do fine in that. I need to go to Anna in New York. Anna.
Welcome. Hi, Jim. So great that you took my call. I'm from Westchester County, New York, in your backyard.
Lucky.
And I'm calling about, I worked for CES, Con Edison Solutions. It was an ESCO company for Con Ed for 15 years. We were bought out in 2019 by Exelon, then Constellations. So through payroll deduction, my CEG stock, I purchased 68 shares for about $2,100 back then. It's worth about $12,700 right
there
now.
You go.
Buy, hold, or sell.
Okay, this stock is under heavy pressure. There's a big rotation going on in it. The rotation hasn't lasted long enough. I think it's going to go for a couple more days because the stock is up 60%. Keep your powder dry. And that ladies and gentlemen, it's the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, give the people what they want. Cramer on lessons from Chipotle and more. Next.
Sometimes it's about the why. As in, why the heck is this stock going down? Sell. That's how I feel about Cramer fave Chipotle right now. There's a fever around Chipotle, a fever that says it's been raising price and shrinking portion sizes. That's a recipe for customer revolt. I put the question to CEO Brian Niccol not that long ago. Here's what he had to say.
We've always said we want to give people great portions. We want to give them what they want. And our team members.
You've not shrunk the portions.
No, we never have. Like from the beginning of time with Chipotle, I think there were billboards that said burritos as big as your head. Like that's never changed. And our teams, they are focused on giving people what they want.
There you go. That was good enough for me. Niccol's one of the best executives we've ever had on Mad Money. Hey, you know what? If he says they haven't shrunk the size, I believe him. Case closed. But what I've realized is sometimes there are issues that dog a company that can't just be put to rest. Who cares about the reality of the situation? All that matters is if Chipotle can convince its customers. Yesterday, we had 100X, the consumer research firm, on the show, and they're all about perception. CEO Rob Pace points out that positive Chipotle feedback has actually been declining. Purchase intent dropped 2 to 3 points since April, and that's in part thanks to the growing perception that the sizes have gotten smaller, despite what the CEO told us. Just a few weeks ago, there was this widely read piece of research from Wells Fargo by Zachary Fadem. He has a buy on the stock, and he, too, is puzzled by the perception versus reality. So what did he do? Oh, I'll just read it to you. Quote, to put the weight debate to rest, we consumed 75 like-for-like Chipotle burrito bowls in New York City, end quote. Turns out the consistency, he said, quote, varied widely with some locations serving bowls that weigh 33% more than other locations, end quote. What that says to me is, while we'd love for every bowl to be consistent, there's no grand plan to reduce the portion size, for heaven's sake, although the standards don't seem to be consistent from location to location, which makes things a lot harder. I'm concerned because as long as people think Chipotle has shrunk the sizes, it's going to be a tough stock to own. I think you got to wait until this issue blows over and everyone comes to their senses. It would help if management imposed more uniformity across the chain. Maybe it can. Here's what matters. I trust Chipotle. I trust Brian Niccol. I believe they deserve the benefit of the doubt. I don't need to weigh 75 bowls, but I'm not the one who needs to be convinced. Had it for lunch today to celebrate the completion of the CNBC Investing Club monthly meeting, and until they get a handle on this misperceptions, owning this stock could be pretty painful. Now, we know 100X is not a stock-picking organization, but I really like the work that shows that Domino's, DPZ, is at the top of the pizza heap with a 97 score versus other top pizza brands with 61. Highest best. How do I use this? Simple. I like the stock at Domino's. I like it more than the other pizza stocks. That's been the case ever since May of 2022 when Russell Weiner took over as CEO. And at the time, Domino's stock was trading at 340s. Now it's at 473. When it reports tomorrow, I think there's a good chance we get a compelling set of numbers. I went over this the other day with you, and the 100X research piece made me inclined to tell you to buy it. Could be wrong, but I like to use this kind of data to ensure that I'm not way off base. We'll see tomorrow, and I don't like to play earnings roulette, so don't do anything crazy tonight, please. In the end, getting stocks right means trying to figure out a mosaic. Until 100X came along, I relied on my own research married to my own view of the product. My family loves Domino's. That's been true ever since the stock was at $10, almost 15 years ago, back when former CEO Patrick Doyle started turning things around and urged me to, yes, eat Domino's. He was right. But you see, my view is purely anecdotal. With 100X, I have what's known as empirical data, which is always better. Doesn't mean it can't be wrong. Does mean that you'll be better with this research than you are without it. Oh, and for the record, I wish I worked with Zachary Fadem at least this once at Wells Fargo on that Chipotle piece, because I would have been happy to eat all 75 bowls, because that's how much I love the taste of Chipotle. I like to say there's always a bull market somewhere. I promise I'll fight just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and/or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.